Shilpa Agrawal, Accounting Faculty of BO Board of Studies. Today's mentoring session is on major changes in Ind AS vis-a-vis existing notified accounting standards. Today's session is in continuation with the previous session, which was on Ind AS roadmap and carve-outs. Before starting with this session, I would like to take up certain queries which were raised by certain students at the time of registration to Google Hangout. Most of the students have this apprehension that this is the first time this topic is going to be applicable for May 16 examination. So what type of questions will be asked? Because we have released a supplementary study material which is running in 271 pages. So they are worried that they have to study so many pages for one particular topic. So students, this is advice from Board of Studies that please focus mainly on differences in carve-outs, differences in differences in Indian accounting standard vis-a-vis existing accounting standards, and carve-outs in Ind AS from IFRS. Please focus your preparation mainly on these two topics, and since these two topics are mainly deals with theoretical, this is a theory topic. So one of the apprehension of the students are that what will be the weightage of this topic. As such, we do not have any institute does not have any policy of prescribing any weightage to any particular topic. Based on past examination, we come to know that this particular topic for this much marks it is asked in the examination. However, since we are prescribing for differences and carve-outs, which is mainly a theoretical question, so in practical question paper or in practical question paper, a theory question is asked mainly of 4 marks, 5 marks, 6, or max to max 8 marks. So it is expected that question will not exceed for 8 marks. It may vary from 4 marks, 5 marks, or 6 or 8 marks. So one of the query is also how Ind AS will be used in future for CA. See students, as you know, Indian accounting standards are more transparent accounting standards. Because of globalization, India is moving out of the country also. The business or the trade is moving is restricted not only to India, but is restricted out of India as well. So in such situations, financial statements are used not only by the investors in India, but also by the investors who are outside India. So for those who are outside India, they need a comparable financial statement so that they can understand whether they should invest in your company or not. So this has been decided that we should also develop a standard, or we should follow a standard which is more transparent and more comparable worldwide. So as a first step, Indian accounting standards, which were notified in 2015, has been made mandatory for certain class of companies from 1st April 2016. However, this scope is going to be later on widened. For certain class of companies, it has been made mandatory from 1st April 2016. Later on, it will be made mandatory to more class of companies from 1st April 2018. And further, it will increase. Like for banking, insurance companies, and non-banking finance companies, a separate roadmap is going to be prescribed. So they will also be in coverage of implementation of financial statement based on Ind AS later on, not in 2 years or 3 years, maybe later on, but they have to also comply with Indian accounting standard in future years. So once you pass out as a chartered accountant and you have to prepare financial statements of those companies on which Indian accounting standards are mandatory. So you should not be left blank. You should understand what are Indian accounting standards, what are the differences, how this accounting is done, how recognition, measurement, presentation part of particular item D's as per Indian accounting standard. So this is a very important standard, and later on, existing accounting standards will also be in line with Indian accounting standard. If you see Institute of Chartered Accountants of India, Accounting Standard Board, which promulgates these accounting standards, they have also issued exposure drafts of existing accounting standards, which are in line, the provisions or the recognition measurement part, which are there in those standards, are based on are in harmony with Indian accounting standards. So we are trying to bring our existing accounting standards also in line with Indian accounting standards. Since Indian accounting standards are notified by companies, it will be notified by Ministry of Corporate Affairs. It will be applicable only to companies. However, we want such provisions or such type of standards to be applicable for non-corporate entities also. So we are trying to bring our existing accounting standard also in line with Indian accounting standards, so that it will be applicable not only for corporate entities but also for non-corporate entities. Definitely it is going to take time, but with definitely it's going to take time, but in future years, maybe down the line 5 years or more, we have to all have to apply, all the companies, all the business entities, whether corporate or non-corporate entities, they have to follow Indian accounting standard or similar standards stating the same provisions or the provisions more or less in line with Indian accounting standards. So they are very important in future and you should learn this. One should always be ready for difficult challenges. Next question is, will practice manual edition January 2016 be enough for May 16 examination with respect to AS, Ind AS, IFRS and differences? No. See, practice manual contains certain number of questions. However, with reference to Ind AS, IFRS is not applicable to you. Only differences in Ind AS, so that is carve-outs in Ind AS versus IFRS, that is applicable to you. To that extent, IFRS is applicable. Otherwise, IFRS overview of IFRS has been removed from the syllabus. In place of that, introduction of Ind AS has brought in. So, practice manual contains only number of illustrations or questions, but the supplementary material which has been released for Indian accounting standards, they contains all the differences in all the 39 Indian accounting standards versus notified accounting standards. So you have to study all the differences. You never know which type of question, on which standards the question has been asked in the examination. So restricting your study only to practice manual for this particular topic will not suffice. What kind of questions will be asked in May 16 examination? See, so students, this cannot be commented on specifically. I have already told for Indian accounting standard, we expect theoretical question will be asked. However, our expectations may also get defeated or overruled. But as of now, we expect theoretical question basically based on differences or carve-outs will be asked in the examination. This I have already replied. Will practice manual edition January 16 will be enough for study? No, this will not be enough. You have to study the supplementary study material. Are there much differences in practical questions given in Ind AS replacing the AS 30, 31 and 32? Here you are talking about financial instrument, topic of accounting and reporting of financial instrument. Yes, this is for the first time we are making financial instrument applicable based on Ind AS 32, 107 and 109. So the concepts given in AS 30, 31 and 32, basically in AS 30 and Ind AS 109 are different, because of which we have shifted from AS 30, 31, 32 to Ind AS. So since concepts are changed, provisions or recognition criteria has changed, classification criteria has changed to some extent, questions also have undergone some changes. So it is very necessary that don't study the old illustrations, refer the new illustrations, new revised chapter 6, which we have issued separately, and we have also included that in the January 16 edition of the study material for your preparation for May 16 examination. Are there major changes between AS 30, 31, 32 and corresponding Ind AS? Yes, there are changes, and because of that only we have come up with the new chapter. The old chapter, which was based on AS 30, 31 and 32 was running for say about 30 pages, but now the revised chapter which we have come out is of about 70 pages. We have included more number of illustrations, basic illustrations for your understanding. We have also covered we have also taken mentoring sessions, 2 mentoring sessions on this topic for your understanding. And please don't refer illustrations given on based on AS 30, 31, 32. Please refer the revised chapter. Whether complete AS and Ind AS and all IFRS for May 16, IFRS are not applicable to you for May 16. Scope of Indian accounting standard and scope of notified accounting standards are different. Existing notified accounting standards you have to study thoroughly, AS1 to AS29, and questions, practical questions based on small case studies, practical scenarios will be asked as it is already asked. It is always asked in the past examination. It can be shall be asked in the new exam in the coming examination as well. However, on Ind AS, I'm again and again repeating the same thing, that theoretical questions will be asked, and so you have to study the mainly differences and carve-outs. However, please refer the summary part also. Go at least once through the summaries of all Ind AS so that you can understand the differences in a better manner. One of the queries, ma'am, which existing AS is completely different with corresponding Ind AS? There are many standards which are completely different from the corresponding Ind AS, like Ind AS 1, the differences which we are going to conduct here to explain today. I am going to explain. Ind AS 1, which is on presentation of financial statements. However, AS 1 is on disclosure of accounting policies. It is not only the title which is different, but also all the provisions, many of the provisions which are there are completely different. So there are many other standards also. I see existing notified accounting standards are rule-based standards. However, Indian accounting standards are considered as principle-based standards as they are in line with IFRS. So IFRS are principle-based standards. So Indian accounting standards will also be considered as principle-based standards. So principle-based standards, and these standards are meant to be more transparent and more comparative. So disclosure requirements, treatment, coverage, everything is wider than what is there in the existing notified standards. So definitely many standards are different. The provisions are very different. There are many differences. Certain standards are more like existing notified accounting standards which were issued later in period, like from AS 19, 20. They were in line with international accounting standards or IFRS. However, the earliest notified standards which we have, they were not in line with this standard, or they have undergone changes, but our existing accounting standards have not undergone that much change. So our starting the standards are 1 to 16 or 1 to 18. They are different from Indian accounting standards. We supposed to remember Ind AS as standard numbering for approaching exams. I think it will be better if you remember at least the name of the standard and name of Ind AS and name of the Ind AS. It is a number and name of the Ind AS. It is very important. It will help you in future also. However, in case you forget, instead of disquoting or misquoting any particular name or number of the standards, better to write as per the standard. However, it's better to remember the name and number of Indian accounting standards as well. Are there much differences in practical questions given in Ind AS? This is the same question again asked. Yes, there are much differences since AS 30 has been completely AS 30 was based on IAS 39. IAS 39 has been completely revamped by IASB, and they have, in place of that IAS 39, they have come up with new standard, that is IFRS 9. Based on IFRS 9, we have come up with the Ind AS 109. So definitely AS 30 and Ind AS 109 are different. So you have to study based on new Ind AS only rather than from the perspective of AS 30, 31 and 32. AS 30, 31 and 32 are not applicable for May 16 examination. An announcement in this regard has been issued and hosted on the website as well as given in the students' journal. So you need not study these three standards for accounting standards and also for financial instruments. In fact, the differences in Ind AS vis-a-vis AS 30, 31, 32, you are not required to study that also. Will examiners expect a note at the end of each practical question highlighting differences in solving answers if Ind AS were to be applied on the respective question? See, students, by giving summary of any Indian accounting standard, I shall not expect you, that will be wrong on my part, if I expect a practical question on Indian accounting standard to be asked in the examination. So that's the reason why I'm again and again advising you to refer, mainly concentrate on differences and carve-outs. And differences and carve-outs will be definitely a theoretical portion. So we are expecting a theoretical question to be asked in May 16 examination on this topic on Indian accounting standard. However, there are very least chance that there will be a practical question on Indian accounting standard. Something beyond supplementary material will not be asked. It is very much sure. So please restrict your study only to the content which is given in the supplementary study material on Ind AS, and don't go beyond that. Don't refer any other book for practical illustrations on Ind AS. With respect or with reference to examination purpose, in the examination hall, in the question paper, it will be clearly mentioned that you have to answer your particular case study or your question based on existing notified accounting standard or Ind AS. It would be clearly stated in the exam, so there is no need of getting confused right now. Suggested answers of November 15 are encrypted. How to access them? For that, you have to contact different faculty. I will not be able to reply on that matter. However, you put a mail on this at on my mail ID, shilpa@ici.in. I will forward the mail to the concerned person and they will be replying to you. In this, I would not be able to encrypt. This is not something related to IT and I will not be able to comment on it. Will you be giving a list of important AS and Ind AS applicable? No, I never give any list of important AS or Ind AS. I do not prescribe, I do not recommend any selective study. And I really condemn selective study. I want you to study all. However, with respect to your time available for the coming exam, it's your choice what to study and what not to study. But from my side, I don't prescribe any selective study. All standards are important. All differences in all Ind AS with service existing accounting standards and carve-outs in Ind AS from IFRS, everything is important, and nothing is like this is less important and this is important. Whether complete AS and Ind AS and all IFRS for May 16 examination. See, please avoid repetitively asking same thing. Otherwise, we will not be able to proceed to the session. And this I have already told. IFRS is not applicable. Yes, AS and all Ind AS. Introduction of all Ind AS and summaries, differences in all Ind AS, vis-a-vis notified AS, and carve-outs are applicable to you, but the scope of study is different. Existing accounting standard has to be studied thoroughly from AS 1 to AS 29, but for Ind AS, you have to study mainly differences in carve-outs. What weightage you expect of the same? I told you there is no policy of prescribing any weightage to any topic by the ICI. However, based on past examination, we come to know that what type of question and of how many marks questions are asked on particular topic. But since we are prescribing to study mainly or concentrate mainly on differences and carve-outs, so it will be definitely a theoretical question. So theoretical question in the practical question paper will not be of more than 4 marks, 5 marks, 6 or max to max 8 marks. So it will be maximum will be of 8 marks, but I may be wrong also. I cannot say specifically because that is examination department who deals with the question paper and examination. Board of Studies does not deal with that. I can only share my guessing with you. Okay. Hope that all the queries have been solved and we move to the session. Okay. Before going through the session or PPT, please note following disclaimer statements. Students are advised to refer to the study material, including supplementary study material, basically Ind AS supplementary material and supplement material or revised chapter 6 on accounting and reporting of financial instruments. You have to study this. E-lectures are available freely on the institute's website. They are free accessible and you have to just register with your student registration number and start learning immediately. Video lectures are even without registration, you can watch them. They are also available at the ICI Cloud Campus. Let's start with the major differences. Significant and major differences in your Indian accounting standards. See, as I already told, one of the query was also raised by the students, which states that which of the Indian accounting standards are completely different from existing accounting standard. This is one of the standard which is almost different from what is there in the notified accounting standard. Accounting standard 1, that is disclosure of accounting policies. As the name already tells you, Ind AS 1 deals with presentation of financial statements. However, existing AS 1 deals only with disclosure of accounting policies. So, since it is presentation of financial statements, so presentation is of what? The presentation is of elements of financial statements, that is like assets, equity, liabilities. Now, assets is also to be further classified into current, non-current. What are the criteria for classification of these assets into current and non-current? Similarly, for liabilities into current and non-current, and many more. These are dealt in Ind AS 1. However, existing AS 1 simply states disclosure of accounting policies. So they have restricted only for accounting policies, but presentation of financial statements includes accounting policies, elements of financial statements, their classification, their presentation, the criteria for classification. So the scope of Ind AS 1 is much wider because it deals with a different aspect. So line by line comparison of the differences between these two standards, Ind AS 1 and existing notified AS 1, will also be difficult. However, we have tried to come out with major differences or major quantitative or qualitative differences which are there, rather going with the word by word expressions. So first difference is explicit statement of compliance. This explicit statement of compliance is the requirement prescribed in Ind AS 1. Ind AS 1 says an enterprise has to make an explicit and unreserved statement in the notes. This is also important. Where the statement is to be given is to be given in the notes. In the notes to financial statements, stating that whatever Indian accounting standards, wherever required in particular transaction, has been complied with. Wherever particular transaction needs particular Indian accounting standard to be followed, they have followed with those all Indian accounting standards. It's not that out of 39 Indian accounting standards you have complied with 30 accounting standards. However, in remaining 9 standards, certain standards were also applicable in your business transactions, but you have not followed that. Then this explicit statement will not be correct. So your explicit statement means that the statement will carry that all the Indian accounting standards has been complied with while preparing the financial statements. So the key word is all standards has to be complied. However, such type of requirement is not there in existing accounting standard. An entity shall not describe financial statements as complying with Ind AS unless they comply with all the requirements. I am again stating. So this all the requirements means even in Indian accounting, suppose you are following Ind AS 1, but in Ind AS 1 there are number of provisions you are following. Out of those, say 20 provisions, you are following only 10 provisions and remaining 10 you are not following. Or there are 39 Indian accounting standards. Out of 39 Indian accounting standards or Ind AS, you are only following say 25 or 30. You are leaving out other 9 or 10 which are relevant for your business transactions. In that case, the compliance of all Indian accounting standards will not suffice with, and the explicit statement will be wrong. So when an entity is complying with Indian accounting standard, they have to submit an explicit and unreserved statement. By what does mean by unreserved? Unreserved means that your statement should be not conditional. It should not be like that, except this we have done this, except this provision in particular standard we have complied with all the. Such type of reserved statement should not be given. However, deviation can be done in Ind AS. Ind AS 1 allows deviation from requirement of an Indian accounting standard, but this deviation is permissible only in case the management concludes that this is to be taken by the decision is to be taken by the management, or they should conclude that a compliance with Ind AS will be misleading, and this misleading will be if the regulatory framework requires or does not prohibit such a departure. Suppose regulatory framework is saying that you cannot make this departure from Indian accounting standards. Till you are making this departure, then this is not permissible. However, if regulatory framework is silent on particular prohibition or particular departure, then you can make it. Or if regulatory framework is specifically mentioned that you have to make this departure, there you can do this deviation, you can depart from what is given in Indian accounting standard. So Ind AS 1 allows deviation from requirement of Indian accounting standard in case management concludes that compliance with Ind AS will be misleading, and that misleading will be, it is to be supported with the regulatory framework requirements. It is not or, it is and. So you have to stress on this particular word and. So, however, existing AS1 does not have any such type of requirements. There's no need of giving any statement stating that you are complying with accounting standards or complying with significant accounting. So only that you have to require a disclosure of significant accounting policies. Fundamental accounting assumptions, if not followed, then only you have to state. If you are following it, you need not state it as per AS1. However, disclosure of significant accounting policy, only accounting policies are required as per AS1. But for Ind AS1, compliance with all Indian accounting standards, altogether with policies, recognition, with everything has to be mentioned. Another difference in Ind AS1 vis-a-vis notified AS1 is current and non-current classification. As I've already told you, Ind AS1 deals with presentation of financial statements. So presentation of financial statement means presentation of assets, equity, liabilities. Assets are further classified into current and non-current. Similarly, liquid liabilities are also classified as current and non-current. So what is the criteria of classification into current and non-current has been explained in Ind AS1. However, this has not been explained in notified AS1 because notified AS1 does not prescribe such type of classification. Later on, earlier in Companies Act also such type of classification was not there, but after revision of Schedule 6, which was in Companies Act 1956, they have come up with this classification of current and non-current, which is in line with IFRS or now Ind AS. This revised Schedule 6 has been continued or overtaken by Companies Act 2013 in the form of Schedule 3, which also contains current and non-current classification. So companies have to prepare their financial statements based on such current classification into current and non-current, but still though they are following existing accounting standards. But AS1 does not prescribe such classification. It is prescribed in Companies Act. But in Indian accounting standard, Ind AS1 prescribes such classification. This need not go to the Companies Act or to refer Schedule 3. You can refer directly Ind AS1 if you are following Ind AS1. Third difference is extraordinary items. The concept of extraordinary item has been done away with in Indian accounting standard. There is no such item as prescribed in IFRS and as well as in Indian accounting standard. This concept was there in existing accounting standards. Is there in existing accounting standards. Notified AS says about extraordinary item. In many standards they deal with this. Like in AS3 they talk about extraordinary items. In AS5 they talk about extraordinary items. But Indian accounting standard has done away with this concept. So they have not dealt with such items. So this is also the difference, major difference. So when they are not continuing with this concept, so they have prohibits the presentation of any item as extraordinary item in the statement of profit and loss or in the notes. Third difference in Ind AS1 vis-a-vis notified AS1 is the disclosure of judgments and assumptions made. See, in notified AS1, we have, if fundamental accounting assumptions are not followed, then we have to make the disclosure. We are not following with the fundamental accounting assumptions. However, if fundamental accounting assumptions are followed, no disclosure are required. But in Ind AS1, you have to mention the assumptions which are made and the basis of those assumptions. The judgment or the basis why you have taken certain assumptions, that also has to be disclosed as per this is the requirement as per Ind AS1. So we'll be stating Ind AS1 requires disclosure of judgments made by management while framing of accounting policies. It requires disclosure of key assumptions made about the future and other sources of measurement. Basis of assumptions, measurement of sources of measurement of uncertainty. These also has to be disclosed. It's not only that I have taken this assumption because of this reason. Because of that assumption, what is the measurement you have done? For that measurement, what are the sources you have used? What are the bases on which you have done this measurement? All has to be disclosed as per Ind AS in your financial, in notes to accounts of the financial statements. Those other sources of measurement or disclosure of key assumptions that have significant risk of causing a material adjustment to the carrying amount of assets and liabilities within next financial year has to be disclosed. Maybe that in down the line it will be, you cannot presume that what can be the impact, but in the next financial year, what are the impacts, that if you are able to materialize it or you are able to measure it, that you have to disclose a source of measurement, that impact, that disclosure of key assumptions, disclosure of judgments, everything. So definitely, because Indian accounting standards are very transparent, more transparent and more comparable, so definitely disclosure requirements will also be much more than what is given in the existing standards. Next is classification of expenses. Financial statements includes balance sheet, profit and loss. So profit and loss means expenses and income. So classification of expenses has also been given in Ind AS 1 based on nature of expense. You have to classify the expenses or present those expenses based on nature of expenses. This has been clearly mentioned in Ind AS 1. However, AS 1 does not talk about such type of classification. Next difference is comparative balance sheets. AS1 requires presentation of balance sheet as at the beginning of the earliest period when an entity applies an accounting policy retrospectively or makes a retrospective restatement of items in the financial statements, or when it reclassifies items in its financial statements. In this regard, I would like to first come up with the proceedings. I will come back to this slide. What are the components of financial statements? As per Ind AS, you have to prepare two balance sheets, two statement of profit and loss, two statements of cash flows, two statement of changes in equity and related notes. Why these are two? Because you have to give the comparative notes. If you are preparing a balance sheet, so it will be current year, and previous year. So in short, you are giving two balance sheets. One data of one current year, one is of, this is the first balance sheet, this is the second balance sheet. Though it is in the one statement, but you are giving two balance sheets. Similarly, for statement in profit and loss, you have to give comparatives of the previous year, immediately previous year. So you are preparing two statement of profit and loss. If you are preparing statement of cash flows, which is one of the requirement as per Companies Act, so you have to prepare two statements of cash flows, two statement of changes in equity and related notes. These are the components of financial statements. However, but when we are following any accounting policy, we are changing any accounting policy, we have to apply it retrospectively. And because of this retrospective effect of change in accounting policy or application of any accounting policy, in between, we have to restate our financial statements from the earliest period, as at the beginning of the earliest period. So what is the beginning of the earliest period? Suppose your reporting date, suppose your reporting date is 31st March 2017. So your current year will be this. What will be your previous year? Your previous year will be 31st March 2016. Now, if I have to give retrospective application of accounting policy, if change or newly applied, then you have to give as at the beginning of the earliest period. So what is the beginning of this balance sheet? Your beginning of this balance sheet is 1/4/2015. Previous year balance comparative figure is to be given for 1 year, which is starts from 1st April 2015 and ended up at 31st March 2016. So the earliest period is 1st 4/15. So you have to prepare a balance sheet on this particular date, and impact of change in accounting policy retrospectively you have to give on this date also. You have to prepare a balance sheet on this date also. So based on this difference, Ind AS 1 requires presentation of balance sheet as at the beginning of the earliest period when an entity applies an accounting policy retrospectively, or makes a retrospective restatement, or when it reclassifies items in its financial statement. So in case of retrospective application of accounting policy, in case of retrospective restatement of items or reclassification of items, you have to prepare 3 balance sheet. One is on 31st March 2017, second is on 31st March 2016, and one is on 1st April 2015 at the beginning of the earliest period. So in such case, you end up with 3 balance sheets. Entity will prepare 3 balance sheets: end of the current period, end of the preceding period, and the beginning of the preceding period. This is end of the current period is 31st March 17. End of the preceding period is 31st 3/16, and beginning of the current preceding period is 1/4/15. So in that case, you have to prepare 3 balance sheets. When an entity is required to present an additional balance sheet, it need not present a related notes to the opening balance sheet as at the beginning of the preceding period. As we have seen in the coming slide, that we can components of financial statements there, that we have to prepare 2 balance sheets, 2 statement P&L. So we have to prepare related notes also of these 2 balance sheets, these 2 statement of P&L, statement of cash flow, statement of changes in equity. But when you are preparing opening balance sheet of the preceding period, or the beginning of balance sheet at the beginning of the preceding period, for that particular period, you are not required to prepare the related notes. You are exempted of preparing such related notes. Next difference is Ind AS 1 vis-a-vis notified AS 1 is on disclosure of reclassified items. In respect of reclassification of item, Ind AS 1 requires disclosure of nature, amount, and reason for reclassification. And these nature, amount, and reason for reclassification is to be done in the notes to financial statements. This disclosure of reclassified items is not dealt only in Ind AS 1. However, AS 1 does not deal with disclosure of such items because there is no classification criteria prescribed in notified AS 1. So there is no reclassification also done in as per Ind AS 1. Sorry, as per AS 1. So disclosure of reclassified items is also not dealt with in notified AS 1. It is dealt only in Ind AS 1. And when you are reclassifying any item, you have to reclassify the nature, amount, and reason also for that. Why are you what is the reason because of which you are doing this reclassification? On reclassification, what is the amount, difference in the amount, why, and if the reclassification changes the nature also, then you have to disclose that also. Next changes, statement of changes in equity. Ind AS 1 requires the financial statement to include a statement of changes in equity to be shown as a separate statement, which inter alia includes reconciliation between opening and closing balance for each component of equity. What is equity here? Equity means share capital plus reserves and surplus. So change in capital, change in each and every head of reserves and surplus: capital reserve, revenue reserve, profit and loss, securities premium, anything, whatever which comes under reserves and surplus, change of each and every reserve and surplus, you have to mention this statement of changes in equity. And this statement is a separate statement as per Ind AS 1, and it includes reconciliation between opening and closing balance. What was the opening balance? What are the additions or subtractions during the year, and what is the closing balance? Just for your information, not as part of your syllabus, just for your information, I would like to say in ASB has come up with a draft schedule 3 based on Indian accounting standard. This draft schedule 3 is also taken up by the Ministry of Corporate Affairs. After discussion with Nakas, they have issued this draft schedule 3 as a press release. They have not notified it yet. So that's why I'm using the term draft schedule 3 based on Indian accounting standard. So whatever schedule 3 right now we are having in Companies Act 2013 is based on accounting standards. You have to prepare the financial statement based on existing notified accounting standard, and for that you have to follow schedule 3. But we will be coming up with another schedule 3 which will be based on Indian accounting standards for those companies who will be mandatory following Indian accounting standard for preparation of their financial statements. They have to follow those that schedule 3 once it gets notified. Right now it is not notified, and this whatever I have told about draft schedule 3 is completely for your knowledge and add-on. It's not part of your syllabus. Next difference is statement of other comprehensive income. Ind AS 1 requires that an entity shall present a single statement of profit and loss with profit or loss and other comprehensive income presented in 2 sections. See, students, in IFRS, they can prepare 2 different statements. One is statement of profit and loss and one is statement of other comprehensive income. But in Indian accounting standard, we have said we have to prepare one statement only, that is statement of, you have to prepare statement of profit and loss. In that statement of profit and loss, you will be giving items which appear in P&L, and after concluding that statement, you will continue with the same statement with statement of OCI, other comprehensive income. Now, what is other comprehensive income? Though here we are dealing only with the differences, but still a brief note about other comprehensive income. Many items which cannot be taken to profit and loss, but these with the income, expenses or losses or gain, basically losses or gain, which cannot be taken to profit and loss is taken to other comprehensive income. This is, therefore, we have come out with a residuary statement, or we can say a statement which deals with such type of items, the other comprehensive income, which deals with items which are not yet recognized as profit or loss, but are in the nature of gain or loss and will be taken later on to equity. We deal it through statement of other comprehensive income. This is also part of statement of P&L as per Ind AS 1. However, such type of nothing is given in notified AS 1. This section shall be presented together. As I told, after concluding with the P&L, you have to continue with statement of other comprehensive income in the same statement. Next difference is other comprehensive income. I would like to most data is item of income and expenses including reclassification and adjustments. When we are reclassifying anything, so that what are the adjustments which are done based on that reclassification. Suppose earlier you were classifying any item as financial instrument as fair value through P&L. In that category you were classifying. So your value was somewhere say 10 lakh rupees. When you reclassified it as financial instrument or financial asset based on classified as amortized cost, on amortized, measured at amortized cost, your value came as 11 lakh rupees. The difference of 1 lakh will be charged to OCI, will be transferred to OCI rather than going to P&L. Such type of items, like on reclassification, something which is not passed on to P&L is transferred through OCI. The components of other comprehensive income includes changes in other components are changes in revaluation surplus, remeasurement of defined benefit plans, gains and losses arising from translating the financial statements, gains and losses from investment in equity instruments, gains and losses on financial assets measured at fair value through other comprehensive. Sorry, where I have told amortized cost, please consider it as other comprehensive classification measured at other comprehensive income. If classification from FBTPL it is going to FBT OCI, then in that case the changes in that value is to be routed through statement of other comprehensive income. Many other elements are there which is to be also placed. Many like components are there of other comprehensive income for particular liabilities. Changes in the value of time value of options, changes in the value of forward elements of forward contracts, such and many more things are there which will come under a group which will be shown in the statement of other comprehensive income. One more thing is inclusion of comparative information. As per Ind AS 1, an entity shall include certain comparative information for understanding the current period's financial statements. So for current period's financial statements, I have to explain how it is this, why this information is. We have to inform it with by giving comparative information. So Ind AS 1 requires to include such certain comparative information in their notes to account, except when Ind AS permits or require otherwise. An entity shall present comparative information in respect of the preceding period for all amounts reported in the current period financial statement. An entity shall include comparative information for narrative and descriptive information if it is relevant to understand the current period financial statement. Last difference which we are right now discussing on Ind AS 1 is classification of long-term loan arrangement. This is also a carve out which was there in from IFRS to Ind AS 1. I have mentioned there also. Let me just recap it. In IFRS 1 says in case of long-term loan arrangement which is classified as non-current, but because on account of breach of material provision, that will be classified as current loan. However, Ind AS 1 says that in case such long-term loan arrangement, which is earlier classified as non-current loan, will be continued as non-current classified as non-current only, rather than to be classified as current, if that lender has agreed to waive before the approval of financial statements for issue. It means certain breach of material provision was done, but after the balance sheet date, but before approval of financial statements. Suppose balance sheet date is 31st March 16, and date of approval is say 31st August 2016. Between this period, if the lender has rectified that breach, in that case, on 31st March 2015, this loan arrangement, long-term loan arrangement, will be continued classified as non-current. However, IFRS says that whether they rectified after approval balance sheet date, it will be considered as or classified as current only. This is the carve out, and to bring this carve out, this particular paragraph is being specifically mentioned in Ind AS 1, which is not there in the notified AS 1. So it comes out as a difference also, that in case of breach of contract or breach of any material provision, any long-term loan arrangement need not be classified as current. This has been specifically brought out in Ind AS 1, and is nothing is AS 1 does not talk about this at all. Next standard which we are going to continue now is on Ind AS 2 inventories. Because of paucity of time, I guess we'll not be able to continue with all. I thought today we'll be covering 4 standards, but let's see. We'll be covering Ind AS 2 inventories vis-a-vis notified AS 2 valuation of inventories. First difference is subsequent recognition. Ind AS 2 deals with the subsequent recognition of cost oblique carrying amount of inventories as an expense, whereas the existing AS 2 does not provide the same. Here, what is subsequent recognition? Suppose on initial recognition, you valued the inventory at cost. Later period, on reporting date, when you have to value that inventory, what we do is cost or net realizable value, whichever is less, is the value of inventory. So if NRV is taken as the value of inventory, it means if it is 10,000 and NRV is say 8,000. So you are going to value your inventory as 8,000. So that difference of 2,000 as per Ind AS 2 will be charged to P&L as decline in the value of cost. It will be shown in the books as an expense. However, as per AS2, it is simply that we carry our closing stock at 8,000 and 2,000 is automatically adjusted as a loss. But as per Ind AS, it will not be considered as a loss. It will be considered as an expense, and this expense will be clearly spelled out in statement of P&L. And this will be clearly spelled out in AS2. However, when inventories are sold or later on, we have a reversal also of this NRV. Sorry, excuse me. We'll be covering in the next coming slides. So first is subsequent recognition. Ind AS 2 deals with the subsequent recognition of cost oblique carrying amount of inventory as an expense, whereas the existing AS 2 does not provide the same. It applies if your cost and NRV, your NRV has been taken as value of inventory. In such a case, the difference between cost and NRV will be charged in the statement of profit and loss as an expense. However, as per notified AS2, it is not charged as an expense. It is directly taken at that value, and that difference is automatically treated as loss. But in statement of P&L, you have to value inventory earlier at cost, and later on the difference is taken to statement of P&L. And in the balance sheet, you do it 10,000 minus 2,000, and you value inventory at 8,000. This is in balance sheet. You do it. This 2,000 is decline in the value, which comes from P&L. Second difference is machinery spares. The existing AS2 explains that inventories do not include machinery spares, which can be used only in connection with an item of fixed asset and whose use is expected to be irregular. See, students, earlier there was a accounting standard interpretation on this, which clearly stated that machinery spares used in connection with an item of fixed asset and whose use is expected to be irregular. It means it is not in every year the same expense is to be incurred on the particular machinery spare. If it is one-time expenditure or expenditure not done every year, is done in every 3 or 5 years, then such machinery spares or such expenditures should be capitalized in relation to the fixed asset in connection with a connected fixed asset. And this same thing was brought in AS2 also, that if that item is in connection with an item of fixed asset, that machinery spare which can be used only in connection with an item of fixed asset and whose use is expected to be regular will not be considered as inventory. This was clearly spelled out in existing AS2, but such type of explanation is not given in Ind AS2. The reason for not giving it in Ind AS2 is that there is Ind AS 16 which deals with such provisions are there in Ind AS 16, so they felt it is not required to deal it in or to talk this about same thing in Ind AS 2 also. So Ind AS 2 does not talk about this. However, existing AS2 deals with that. Inventory held by commodity brokers, traders. Inventory is held by commodity broker traders. This standard does not apply to the measurement of inventories held by commodity broker traders who measure their inventories at fair value less cost to sell. See, for valuation of inventory, it is necessary inventory should be valued at cost or net realizable value. However, if commodity broker traders measure their inventory at fair value, then that will not be covered in Indian Accounting Standard 2. Though it is not covered in Indian Accounting Standard 2 because they are measuring their inventories at fair value, still a guidance has been given in Indian Accounting Standard wherein they have said what is fair value, what is NRV, what are the differences between fair value and NRV, and they have simply given us basic guidance about measurement of commodity breaker traders, but still it will not be considered as part of Ind AS 2, because as per Ind AS 2, measurement of inventory should be at cost or net realizable value, not at fair value. And in continuation to this difference, Ind AS 2 has also dealt with the definition of fair value, because the Ind AS 2 has given a guidance on commodity broker traders, so they have also dealt with the definition of fair value, on the basis of which commodity broker trader measure their inventories. And because AS2 does not talk about commodity broker trader, so they do not talk about fair value also. Next difference is subsequent assessment of NRV. Ind AS 2 talks about what is existing accounting standard 2 or notified accounting standard 2 talks about what is NRV, but subsequent assessment of NRV is not dealt with notified AS 2. However, Ind AS 2 deals with subsequent assessment of NRV. They say that whatever NRV, if you have taken in the first year and have valued your inventory based on NRV in your first year, that NRV have to be reconsidered every year till the time inventory is there in your balance sheet, is appearing in your balance sheet. So Ind AS 2 provides detailed guidance in case of subsequent assessment of net realizable value. It also deals with the reversal of the write down of inventories to net realizable value to the extent of the amount of original write down, and the recognition and disclosure thereof in the financial statement. This I would like to explain you with the help of an example. Suppose in current year 1, or in your financial year 1, cost was 10,000, NRV was say 9,500. You valued your inventory at 9,500. In that case, in financial year 2, cost was 10,000 again. This is going to be same, but NRV is now 9,800. So you have to value your inventory at 9,800. So what will be the treatment of this change in the value? In the first year, as we have told you, in subsequent measurement, first difference which we have taken in this Ind AS 2 vis-a-vis notified AS2, subsequent measurement or subsequent valuation of it, the difference is charged to P&L. So this 500 was charged to P&L in financial year 1. It was charged to P&L as decline in the value as 500, charged to P&L. In financial year 2, when out of 500 only 200 is still the decline in the value and 300 has been recovered, your NRV has increased. In such a case, this 300 out of this 500, to the extent of 500 only we can reverse it back. So there will be a reversal of NRV. NRV will be reversed back, and this 300 will be reversal of decline in value of previous year. This will be shown as an income. So in your balance sheet, your inventory which is now appearing in financial year 1, it is appearing as 10,000 minus 500 as 9,500, and in balance sheet 9,500 plus 300. So now this 300 is what? Reversal of NRV. Your value of inventory will be 9,800. So 9,800 will appear like cost and NRV, whichever is less. Though we are comparing, we are reversing this thing. We are comparing here from 9,500 to 9,800, and we are see cost was 10,000. The NRV was 9,500. Now the NRV is 9,800. So 300 is the reversal of NRV, and we are going to increase the NRV value and now value the inventory at 9,800. But it will appear like that we have compared the cost and NRV of the second year, and whichever is less is taken as the value of inventory. Next difference is exclusion from scope but guidance given. AS2 excludes from scope only the measurement of inventories held by producers of agricultural and forest products, agricultural produce after harvest, and mineral products, though it provides guidance on measurement of such inventories. However, the existing AS2 exclude from scope such type of inventories. So let us first understand what is given in existing AS2. Existing AS2 says that producers of agriculture and forest products or such type of agricultural produce after harvest or mineral products are not inventory as per AS2. They are not covered as not dealt with as per AS2. They are not in the scope of AS2. They are out of the scope. However, Ind AS2 say they are inventory as per Ind AS2, but the measurement basis for the purpose of measurement, you have to follow the respective Ind AS. For agriculture produce and forest products and after harvest, there is separate Ind AS, that is Ind AS 41, agriculture. For mineral products, we have a separate Ind AS, that is 106. So for measurement portion, you have to refer Ind AS 41 and in Ind AS 106 for respective items, but definition wise, they will be covered as in Ind AS 2. They are inventory as per Ind AS 2, but the measurement of such inventory will not be dealt as per Ind AS 2, will be dealt as per Ind AS 41 and 106. However, existing notified AS2 says they are not inventory at all. So that is the major difference. Cost formula. Existing AS2 specifically provides that the formula used in determining the cost of an item of inventory should reflect the fairest possible approximation to the cost incurred in bringing the items of inventory to their present location and condition. So existing AS2 says whatever formula you are using for valuing the inventory, like for FIFO method or for weighted average method or standard costing, specific, whatever the formula you're using, it should reflect the fairest possible approximation to the cost incurred. However, such type of condition is not mentioned in AS2. In AS2 simply states that whatever formula you're using for valuation of inventory, that has to be in consistency. Year after year, you have to use that formula only for similar nature of the inventory. Further, Ind AS 2 requires more disclosures. I already told you that Ind AS, every Ind AS have more disclosure requirements so that it is more transparent to the investors, to the stakeholders, or the users of financial statements. So the disclosure requirements will definitely be much more in comparison to the notified standards. Before moving to the next standard or differences, let us see the queries. Please use a different light color ink. Sorry, I haven't seen it right now. So next time I'll take care of this. We'll be using white color instead of that. Is change from current to non-current be considered as reclassification? Well, see, current and classification of particular item into current and non-current is basically on the basis of the criteria, that is whether it is to be settled down like in received or to be paid off within 12 months from the reporting date. So that classification has to be done every year. So that classification will not be considered reclassification because that classification has to be done afresh every year. So we cannot continue with the old year's classification. And this classification is basically for presentation, not for measurement or recognition. So it's basically for presentation, so that will not be considered as reclassification. If only some Ind AS are complied, then only an explicit statement is required in Ind AS 1? No. Explicit statement should state that all Ind AS has been complied altogether in one go. In that should be unreserved statement. If you are saying that but only 5 standards we are complying with and remaining 34 standard Ind AS we are not complying with, then it will not be considered as explicit statement. It will not be an unreserved or explicit. It is a reserved statement. And AS Ind AS 1 requires an explicit and unreserved statement which states that all Ind AS has been complied. So this will not be complying with few standard Ind AS will not be considered as explicit statement. Will these PPT be uploaded on viii study portal? See, we are planning to record the mentoring sessions and to later on upload it on the website. Hopefully by in the month of March it will be uploaded. So yes, along with PPT, the mentoring session will also be there in the recorded form. But in the month of March, I guess it will be available to you. Keep following the Cloud Campus. You will be getting that. This has the material given in supplementary study material been incorporated in study material edition 2016? Yes. January 2016 edition of financial reporting study material contains the supplementary study material on Ind AS and as well as revised chapter 6 on accounting and reporting of financial instruments. So those students who are having January 15 edition of the study material, they can buy only the supplementary on Ind AS and revised chapter 6 and can study with that. For practice manual, they can buy January 16 edition. However, if they are they have to buy the new edition, please go through buy the January 16 edition, and in that case you are not required to buy separately supplementary materials. Please allow us few seconds to note such points. Students, as I already told you, we are going to give this as a recorded lecture in video lecturing section later on, not now, maybe in the month of March. It will be there in the Cloud Campus as a recorded video lecture. So need not worry. Whatever the PPT which I have prepared is also there in your supplementary study material. That content are there. For further explanations, whatever I have told you beyond the content, that you will be getting it in the recorded form, which will be uploaded on the website in the month of March. So need not worry for that. What do we mean by reclassification of item? Students, see, we are having certain paucity of time. Next mentoring session is at from 3 o'clock. So I'm just trying to take the technical queries, which I can take it right now. Otherwise, I would request you to please mail me over my mail ID. My mail ID is shilpa@ici.in. We'll put it at the end. We'll show the PPT where you can note down the email IDs or the phone numbers to put up the technical queries which has not been answered right now. What do we mean by reclassification of items? See, in many standards, particular items which has to be measured or has to be recognized, they have to be measured in a particular category or to be classified in a particular category. If you are changing that category of measurement base, so basically in financial instrument which we have covered earlier, there are three financial assets are measured in any three of the classification: measured at amortized cost, measured at fair value through P&L, measured at fair value through OCI. If you are interchanging this category, then that is reclassification, and the impact of interchanging from one classification to other is to be routed through OCI in case you are changing the category of fair value through P&L to fair value through OCI. From amortized cost to fair value through P&L, then you have to route the differences through P&L account only. But if you are changing the category of classification, that is, you are reclassifying your financial assets from fair value through P&L to fair value through OCI. In that case, yes, you have to route it out through OCI. Example for comprehensive item, please. In that regard, I would like you to refer the notified Indian accounting standard, which is there on the website of the MCA, which states what are the items like revaluation reserve, impact changes in the revaluation reserve, change in the valuation of options or forward contracts. These items are routed through OCIs. There are many more examples which will be there, but right now, because I have already explained this, because of paucity of time, next time please. Yes, I will. One of the queries that we are going to cover 39 Ind AS differences. Yes, We'll try. We have scheduled 6 mentoring sessions in the coming 2 in the month of March, 2 in the month of April, 2 in the month of February. Today is the one session. Next session is on 25th February. Yes, we'll try to cover all the differences right now because we are having next mentoring session at 3 o'clock. I'm not able to stretch that. Otherwise, I plan to cover 4 standards this time, but only 2 standards were covered. But next time, definitely, as lot as 3 to 4, we'll stretch it out. We'll try to cover all the Indian accounting standards. At least important differences we'll be trying to cover it out. What do you mean by judgment made by management? Judgment is the basis on which you are taking any decision. So that decision, what is the decision and what is the basis of that decision? Based on which facts, based on which papers you are taking this decision. That is the judgment which has to be disclosed by management. And the key assumptions, if they're assuming something that market will rise later on or market will fall later on, the key assumptions also they have to disclose it. That is judgment. Is this first class for major changes after previous session of cover? Yes, this is the first class for major changes. We'll be coming with another 5 sessions also on this major changes in Indian accounting standard vis-a-vis existing accounting standards. Will AS become redundant when Ind AS are amended? No. There will be 2 set of standards. One is on one is existing accounting standards and other Indian accounting standards. Companies, those who are following Indian accounting standards, they are not required to prepare their financial statements based on existing accounting standards. And those companies to which Indian accounting standards are not mandatory, they have to prepare their financial statements based on existing accounting standards. For non-corporate entities, there are no Indian accounting standards. It's only existing notified standards. So, sorry, existing accounting standards. So, existing accounting standards are not going to be redundant. At least down the line till 5 years, it is not going to be redundant. Should we refer all Ind AS or only Ind AS 109, 110, and 111? I don't know why you have mentioned these 3 standards basically. 109 is on financial instrument, 110 is on consolidation. Okay, I got 110 is on consolidation. You are not required to refer it for the topic of consolidated financial statement. For that, you have to study based on AS 21 only. Summary of Ind AS 110 and differences which is covered as per chapter 2 Indian accounting standard, that you have to study, but the topic consolidated financial statement has to be prepared on the basis of AS 21 only. No. See, in this query, I would like to say, in the examination hall, question paper will clearly state that you have to reply on the basis of existing accounting standard or Indian accounting standard. We are hoping this, and I hope that this will be there in the question paper also, that there will be a clear mention of that what you have to reply on what basis. For accounting standards, existing accounting standards, we expect a practical numerical question. However, for Indian accounting standard, for the May 16 examination, we are expecting theoretical question. Maybe our expectations are defeated or overruled, but right now we are expecting that a theoretical question will be asked from this topic. Still, we tell you, please don't restrict your study to the content of the supplementary material or chapter 2 of May 16 edition, January 16 edition of the study material. Don't go beyond that. Don't study beyond that. This is with reference to the supplementary study material issued by ICI. Yes, this online mentoring session is on those differences only, and whatever we are explaining right now is given in the supplementary material as differences. Everything is given there, and we are explaining those differences only. No, you're not required to study AS 30, 31, 32 at all. You are unnecessarily wasting time by studying AS 30, 31, and 32. It is not required because you have to study the topic of accounting and reporting of financial instruments based on Ind AS 32, 107, and 109. So please don't study AS 30, 31, and 32 at all. Please confirm that we have to do only one Ind AS vis-a-vis AS to carve out. I'm not able to understand this query. Please put it on my mail ID. What do the phrase carve out, carve in mean? Please explain the concept with an example using any Ind AS. Okay. Carve out means whatever the provisions which were there in IFRS has not been but has been deviated. That is carve out. Something which is there in IFRS but we are not accepted the same thing. We have deviated from that provision, and because of that, that accounting treatment has changed. That is carve out. Carve in is that something whatever is given in IFRS we have continued that in Ind AS, but beyond that we have given something extra. That is carve in. That extra will not be in contradictory with the IFRS, but it is a further explanation or in addition to what is there in the IFRS. So that is carve in. Why all differences between Ind AS and IFRS does not result in carve out? Please explain this concept with an example using any Ind AS. See, certain, like there are options given in IFRS. You have to treat either in this manner or in that manner. If I am continuing in Ind AS only one manner or one option, I am not continuing, or it simply can say that I am not giving the option in Ind AS. IFRS is giving you the alternative treatment, but I am sticking to the one particular way of doing one thing. Say for classification of expense in IFRS, IAS 1 presentation of financial statement, they have said classification of expense should be based on either nature of expense or function of expense. But we are saying that as per Ind AS 1, classification of expenses should be based on nature of expense. We are not saying that you have to not do either nature or function. We are saying only nature of expense. The classification base should be nature, not nature or function. However, IFRS is giving the alternative that you can classify the expenses based on function. So we are restricting to this. So this is not in contradictory to IFRS, but we have restricted to one alternative only. That's why it is the difference which is not resulting into carve out. This I have explained what is not resulting into carve out. Certain differences or alternative treatments which has not been continued. Alternative treatments prescribed in IFRS which has not been continued in Ind AS 1 will be considered as differences not resulting into carve out. Why all differences does not result in carve out? I explained this already. Please, because of paucity of time, don't repeat the question. In case you are not able to understand it, please mail me on my mail ID. Under other comprehensive income statement, is it only the incomes which will have to be disclosed, or both income and expense? It's not income and expense. It is basically losses and gains, and both can be disclosed in other comprehensive income. Thank you, students. I hope this mentoring session you have understood it clearly and you are able to use it optimally. And in case of any doubt, you can contact me on my mail ID. This is my contact number. This is 3045916 and STD code is 0120. You can also mail me at shilpa@ici.in regarding any query regarding today's mentoring session or on the topic of Ind AS or on the topic of financial instrument or anything which is given in BUS publication. You can mail me at my mail ID. Thank you.